purpose of this video is to inform consumers and professionals of the possibilities by sharing with you actual results from the Debt Advisory Alliance Mortgage Modification Solution. This is case number 119-09. It's a portfolio lender solution, and we're going to talk about how the loan modification opportunity with the Debt Advisory Alliance gets results and avoids another foreclosure. My name is Dylan Kramer, and I am President and CEO of America's Mortgage Choice, as well as Regional Director of the Debt Advisory Alliance. They've asked me to review this modification because it's pretty complex and very mortgage intensive. So we're going to spend a little bit of time taking a look. What we first have was the current loan, which was a loan of $443,000 on an option, ARM, or a pick-a-pay loan, fully indexed at 7.117%. The principal and interest payment was $28.83, and obviously the consumer could not make this payment. Most modifications basically come back and say, here's your offer. It's a 30-year fixed at X percent. It's a 10-year ARM at X percent. However, this customer's letter, which has been indexed here in these three options, came back and said to them, you can choose. But it was handwritten in prose like an algebra high school word problem and was very difficult for the consumer to figure out. I had the chance to review it. We were able to figure out that the bank was asking the customer to choose which option they would like. The first one was to choose a 4.997 10-year fixed principal, interest, taxes, and insurance loan. This option would give the consumer a payment of just under $2,200 and save them just under $700 a month. The second option was a 4.223 6-month adjustable principal, interest, taxes, and insurance loan, and it dropped the payment to below $2,000 a month, saving the customer $900 a month. The third option was a 5.5% interest-only ARM for 5 years. It would be slightly higher than the 6-month at $20.29 a month, or $54 a month higher, and save the consumer $853 a month. Both of the benefits of the third option and the second option were touted by this lender, but the first option was almost dismissed as kind of a casual offer. However, upon reviewing the mortgage options, we discovered that the best loan for the client's long-term security was to get a principal, interest, taxes, and insurance loan guaranteed for 10 years. The 6-month loan would really just put the consumer right back into this problem 6 months down the road and was no solution for them in the long run. Here, with today's challenges in the housing market, an interest-only loan would have the consumer with the same $443,000 balance 5 years down the road. So this bank was basically hoping the consumer would opt for something better for the bank rather than the best possible solution for the consumer. However, we were able to advise the consumer that we felt this option was best, and that was one of the ways that we lent our mortgage expertise to the loan modification experience. This result was excellent for the consumer because they were a portfolio lender. We were not going to get a 30-year fixed out of them, but we did not get the consumer back into an option ARM. As a matter of fact, this modification was offered at a 2.4% margin, and the lender had more flexibility to modify the features of the loan. This client was also able to preserve their credit and stay in the property. Benefits of loan modification include the owner's ability to retain the property. Additionally, they avoid the embarrassment of foreclosure because the loan modification process is discreet. It allows the consumer to conduct business with their mortgage and real estate professional and their attorney exclusively without the public disclosures associated with foreclosure. It keeps neighborhood values locked up because another distressed sale does not come to market. We don't have to chop the price to get rid of the house. We stay in the house. By getting legal representation, attorney representation is the key to winning successful loan modifications. It is a renegotiation of a contract and must be done by an attorney. When that happens, we can lower rates and payments, correct past due balances, and prevent foreclosure, as well as preserve the consumer's credit by making sure the foreclosure does not hit their report. Using an attorney will get you maximum results. What is the Debt Advisory Alliance? It's a collaborative approach towards debt management. The Debt Advisory Alliance is a nationwide network of legal, mortgage, and real estate professionals combining to commit to consumers, working their efforts in a collaborative way, getting the absolute best solution for property owners by using the leverage of the attorney, the expertise of the mortgage lender, and the current market conditions knowledge from real estate professionals to combine to work with existing lenders to get modification results. If you're interested, please contact us directly. Every result is going to vary. This presentation is designed to educate and inform, however, is not to be seen as a promise of a result. Each case is unique as a fingerprint. Property owners can contact us for a referral to a Debt Advisory Alliance member by calling 800-313-6639 or sending an email to info@debtadvisoryalliance.com. Professionals may also inquire about the Debt Advisory Alliance at the same points of contact to learn more about helping property owners with loan modification, loss mitigation, also known as short sales, forbearance workout agreements, debt settlement services, and negotiations to charge off loans for pennies on the dollar. We hope this message helped inform you about the possibilities of loan modification. Please be sure to review our other results. Thanks for your time and consideration.